Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 193 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be talking about investing, and specifically how investing early is more important than investing often. Now, that's not to say that you shouldn't invest often and you shouldn't invest systematically. But what that does mean is that putting money away earlier will benefit you more than just systematically putting away money. And I'll give you several examples as to why and show you that the earlier you can start, the better off you will be. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that is specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now, I have preached to you time and time again that you need to start early when it comes to your investing. Now, starting early does not mean that you should break the financial action plan. You should definitely follow the financial action plan because you need to build a strong financial foundation for yourself before you really get into the thick of investing. But you want to begin as early as possible, which is why in the financial action plan, once you are budgeting monthly in a unique way, right? A unique budget to every single month, right? And you've put away 1 month's worth of expenses into an emergency fund, then I tell you, you can invest up to the match in your employer-sponsored retirement account. And the reason, one of the reasons at least, that I tell you to do this is because starting early is the best thing that you can do for your investing life. Is you can start early. You can start as early as possible and allow money to compound for you over time, because time and compound interest creates some very beautiful nest eggs later on. And you would be very, very surprised in the fact that the amount of money that you need to put away total in order to get to a really nice nest egg, if you start early, is not that much. And I'll give you a quick example as to what I mean by that. So let's say you have two individuals, okay? And both of them are going to invest at some point, but they're going to invest at different points. Let's say individual one invests $250 a month for 10 years, starting at age 25, okay? So $250 a month for 10 years, starting at age 25, and then stops and does not invest again, okay? And let's say that that individual makes a 10% rate of return on their money over time. Well, that person only invested $30,000. $250 a month over a 10-year period would be $30,000. Okay, so that individual only invested $30,000 total. Okay, yet when they get to age 65, they have $982,966.17 given a 10% rate of return. Not bad for having only invested over a 10-year period, okay? So that individual started early. Well, let's say there was another individual, right? And that person, they did not invest until they were 35 years old. But when they were 35 years old, they didn't just put away $250 a month. They put away $375 a month. And they did that from age 35 all the way until age 65. So whereas the first person invested less, invested $250 a month for only 10 years, this other person is investing for a 30-year period from age 35 to age 65 and is investing $375 a month. So another $125 a month over what the first person was investing. Well, when they get to age 65, they had invested a total of $139,500, which is way more than the first person, right? The first person only invested $30,000 total. Well, this person invested $109,500 more than the first person. Yet, they only end up with $941,158.54 given a 10% annual rate of return. And so, what does this tell us? This tells us that the first individual starting earlier, giving their money more time to grow, more time to compound, allowed them to have a larger nest egg. Now, albeit not by much in this situation, not by much in this particular example, right? But think of how much bigger this difference would have been if the second person would have just invested the $250 a month that the first person did, or invested less than that, or invested for not 30 years in a row, right? So what does this tell us? This tells us if we want to invest, it's better to invest less earlier than it is to invest more for a longer period of time later, in most cases, right? If you're talking about comparable cases. Now, obviously, you can invest enough money to catch up later on, but the whole idea is that you're going to have to invest so much more than the first person in order to catch up to the amount that they invested. Just think, right? Whereas the first person only invested $30,000 total versus $139,500. That's $109,500 that the first person could have done whatever they wanted to with during the course of their working life, and the second person was being forced to invest that to even come close to the amount of money that the first person had saved in their nest egg over the full 40-year period. And so quite clearly here, and this goes to the whole idea of today's episode, investing early is better than investing often. Now, again, this is not me telling you I don't want you to systematically invest, or that I don't want you to be putting money away in increments over time and consistently growing your nest egg. That's absolutely the way you should be doing things, okay? But my whole spiel is that if you're going to starting earlier is going to be better for you, because you're going to be forced into a situation where you have to invest more to catch up to other people who haven't invested as much, right? I talk all the time about the example of if you make a 10% rate of return and you invest from age 25 to age 65, $158 a month, right? You can become a millionaire. But if you simply just ratchet that up a couple of years, right? If you just wait to invest a couple more years, the amount per month that you have to put away changes drastically. If you just waited another 5 years to start investing, let's say you didn't start at 25, but you started at 30. If you just waited another 5 years, you would have to put away another $105 a month over the 35-year period now, because the one person was investing from 25 to 65. Now the other person is going to be investing from 30 to 65, right? They're going to have to put away another $105 a month just to get to that $1 million number that the first person was having to put away $105 less per month in order to get to. And $100 a month can turn into a lot of money over time. If we're talking about $100 a month, then what's that, $1,200 per year? You look over a 10-year period, that's $12,000, right? You take that over a 30-year period, that's $36,000. You take that over the 35-year period, and you are looking at $42,000 difference just by waiting a few years in order to get to the exact same point as somebody who started a few years before you did, right? This is a big deal. Starting early can make a world of difference. It can make a huge difference in your investing life. And that's why in the financial action plan, I get you to start early, right? I get you putting something away early, because putting something away early and getting that match early on is going to allow you to get some money working for you and get you compounding towards your future. And you notice we don't waste any time between that and trying to get you to invest in large portions later on, because getting out of debt shouldn't take you more than a couple of years. And building up a fully funded emergency fund should not take you more than 6 months tops to build up the emergency fund that you need to build up, right? So once we can do those things, right, then we can really jump into investing aggressively. And at that point, we're not talking about putting away $158 a month or $263 a month, right? We're talking about putting away 15% of our income. And the reason that we're choosing that amount is because we know that some people are going to fall behind. And we also know that there are people out there that, you're listening to this episode or watching this episode, and you're thinking, well, I'm 38, I'm 40, I'm 45. How do I catch up? Well, the way that you catch up is by taking large portions of your income and investing them systematically over time, right? And that's why we pick a 15% number, because really, regardless of where you are age-wise, right, or regardless of where you are in your financial situation, right? If you can start putting away 15% of your income, you can build some type of nest egg that can be beneficial to you. Now, obviously, the more time that you give up, you may have to work a little longer. You may have to sacrifice a little more to live the retirement life that you want to live, or to live comfortably in retirement. But you will still have to be putting away large portions of your income, and at least 15% of your income is absolutely necessary in order to build anything substantial over the long term. So early is better than often. Now, what if you had a large sum of money, right? Let's say you came into an inheritance, you got some life insurance payout. Let's say you won the lottery, even though I don't want you playing the lottery, right? We're not trying to gamble our money away. But let's say you have some amount of money. Maybe you have some money in savings that you actually need to be investing because you have plenty of extra money in savings, right? How do you go about putting that money away? Well, again, in this situation, early is better than often. Okay. Now, the difference between early and often, what we're going to call them, early would be what we call the lump sum method, where you take just all of the money that you have there and invest it all at once. Okay. You don't spread it out over time. You just invest it all at once. Well, then there's also what's known as the dollar cost averaging method. And the dollar cost averaging method is worth looking into, is worth thinking about, because dollar cost averaging with systematic investing is a very, very good thing to do, right? All that this means, all that dollar cost averaging means, it means that you are putting the same dollar amount into some investment every single month or week, or however often you are going about investing, right? You're putting the exact same amount in, and you will be buying at higher levels when prices are higher. You will be buying at lower levels when prices are lower, right? And you will average out your cost. And this only occurs as you buy high and buy low and buy high and buy low, and then you naturally get an average cost out of the money that you're putting away. And that happens naturally in 401ks when you're putting money away every pay period, or in your IRAs if you're systematically putting money away in those, right? You will dollar cost average if you're putting the same dollar amount away into your investments every single time. Okay, but some people think that it's good to dollar cost average a large amount of money, some lump sum of money, right, into investments instead of putting it all away at once. And their argument here is that, well, what if you put it into some investment and the market drops all at once? What if you put it in and the market just plummets right after you put it in, right? That hurts your returns, obviously. Well, that's not how the data bears out. Now, that's a perfectly good consideration to take, okay? Because it could happen, okay? It could absolutely happen that you put a lump sum in and the market drops immediately. And if you dollar cost averaged in, right, you may have a little bit of money that plummeted, but you'll be able to average your cost from there, and your costs will be lower than the individual who put all the money in at the beginning. That is the argument for dollar cost averaging. But again, that does not hold in the data. The data does not bear that out. History favors lump sum investing. Okay. While there's a lot that we don't know, we do have several factors that can help us make reasonable decisions. Vanguard published a study in 2012 that compared lump sum investing with dollar cost average investing, right? And I use Vanguard for my own investment, so this is a company that I really trust, and the work that they do is very, very good. Okay, here's how the study worked. Vanguard looked at 3 different markets: the US, the UK, and Australia. It then examined 10-year periods, rolling 10-year periods from 1926 to 2011. The rolling periods incremented by month, right? So Vanguard examined over 11,000 10-year rolling periods. Okay, it considered different stock bond allocations. For dollar cost averaging, Vanguard looked at periods ranging as short as 6 months to as long as 36 months. They found that at the end of the 10-year period, lump sum investing beat dollar cost averaging about 2/3 of the time. The results were consistent across the US, the UK, and Australia. Okay, so if you're a numbers person and want to take the approach that gives you the best chance of having more money, then according to the study, lump sum investing would be the best approach. Okay, it just allows you to get greater returns, and naturally it makes sense because more often than not the market is going up over some period of time. Okay, and if the market is going up over some period of time, on average going up. The daily fluctuations don't necessarily mean a whole lot to us. But as long-term investors, if we know that the market's going to go up most of the time, then putting money away all at once and just allowing it to grow, because 10 years from now, the stock market will naturally be higher than it is today if history bears itself out. So you can see why this lump sum investing works most of the time. Okay. Now, if you want to avoid losses, then dollar cost averaging is the way to go. Okay, so you may be more concerned about losing money than you are about maximizing your returns. So for instance, if you are coming close to retirement, if you're in some older age, if you're trying to preserve capital a lot more than you are trying to grow your money, right, then Vanguard study provides insight into this perspective. What it found was that during a down market, dollar cost averaging resulted in losses less frequently than lump sum investing. Specifically, the study found that lump sum investing declined in value 22.4% of the time. Dollar cost averaging was down 17.6% of the time. So if your concern is preservation of capital, dollar cost averaging may be the better approach for you. Okay, so here we are not arguing that the returns of dollar cost averaging are better, because they've already told us that the returns of dollar cost averaging are not better, right? Investing early provides you better returns than investing often, okay? But what it is telling you is that if you are trying to preserve capital, if you're trying to minimize losses, okay, not maximize gains, but minimize losses, then investing often is better than investing early. Okay, but for the vast majority of us, we are trying to build our nest egg over time. We are trying to build the money that we have saved for retirement or saved for our future, and we're trying to grow it at a good clip, right? We would like to grow it at least the market's prevailing rate of return. Well, in doing so, we want to take this lump sum investing approach. We want to take any lump sums of money that we have and just put them all in at once and allow them to grow over time. That will end up serving us better statistically, right? Not just anecdotally, but statistically than any other type of investing approach that we could take. Now, dollar cost averaging, perfectly good, perfectly fine method, perfectly good thing to do, especially if you are systematically putting money away from your check every month, every week, or whatever, right? But if you have a lump sum of money, then invest it in a lump sum way. Don't just put it away in a dollar cost averaging type of way, because you will likely miss out on returns that you could have made otherwise. Okay. Now, while lump sum investing wins out most of the time, the difference is relatively small. Okay, so assuming a 60-40 portfolio, that means 60% stock allocation, 40% bond allocation in the portfolio, right? And this is in the United States. Lump sum investing beat out dollar cost averaging after a 10-year period by 2.3%. Okay, so we're not talking about huge sums of money, right? So while we're believers that every basis point counts, right? We believe that getting higher returns matters, right? For most of us, it's probably not a life-changing decision. Now, even though that is true, okay, 2.3% compounded over long periods of time can be very substantial. Now, we're talking 10-year periods here that it's a 2.3% difference. So that's not huge, right? The Dow and the S&P diverge by more than that over a 10-year period, and I would be willing to invest in either one of those over the long term, okay? So this isn't a huge difference, right? But again, investing early proves to be better than investing often. Now, a lot of the reason for this really goes back to the idea of the time value of money. The time value of money, right, tells us that money today is more valuable than money tomorrow. Investing money today is going to be more valuable than investing money tomorrow, because you are likely to miss out on gains, and you are especially likely to miss out on gains if you are investing in assets that appreciate over time historically. Okay, and that's what we're talking about when we're talking specifically about the stock market and the bond market. So I've proven to you that investing early works out better when it comes to returns and outcomes in nest eggs, right? But what I want to leave you with is 5 reasons why you should invest early. 5 reasons why you should start investing as early as possible. First reason is that time allows you to take more risks. Okay, the more time that you have to invest, the more risky your investing can be. Okay, you can put money away into individual stocks that may have more variable returns, maybe more growth-oriented stocks. You can put your money into small cap indexes or mid cap indexes that might have more growth potential than just an S&P 500 index fund or something of the like. So typically when it comes to investing, ventures that are more volatile yield the highest return on investment, right? So investors who have more time to recover if something were to go wrong have the opportunity to make riskier moves. Those who begin to invest late in life are often inherently more cautious with how they invest their money because they can't take the losses and bounce back as well as somebody who may be investing earlier. So that investing earlier is going to allow you to take more risks, have more fun with your investing. That's not to say that we're gambling or speculating, but that's to say that we may be willing to take on a little more risk, maybe a tad more speculation in our portfolio, maybe a lot more in the way of calculated risk in our portfolio than somebody who starts later. Right? So that's reason number one, that we can start earlier, or that we should start earlier. Second reason, and this is really what I've talked about earlier in this video when I talked about the two individuals that were investing in different amounts, but one only invested 10 years and one invested for 30 years, that compound interest really makes a difference. Okay, compound interest, that means money growing on money, right? So that means if I invest $100 today and it makes 10% in the first year, then we have $110, right? But if it makes 10% in the second year, we don't just make another $10, right? Now we're making 10% of the $110, so we make $11, right? And so now our 110 becomes 121, not 120. And that difference between the simple interest amount being the $10 here, and the compound interest amount just increases as time goes on, because you're not just making interest on your principal, you are making interest on interest. Therefore, we are calling it compound interest. So compound interest makes a huge difference in the amount of money that you end up having, and in the amount of money that you have to invest to get to a certain amount of money that you end up having. So starting early allows compound interest to work for you. Third reason that you should start early is that your spending habits will improve. So this is a little different from some of the things that we've talked about already in today's episode, right? But investing early allows you to develop disciplined spending habits by focusing on your budget and cutting expenses when needed, right? Because if you start early investing, that means you are sacrificing your spending, you're sacrificing putting money elsewhere early on in your life in order to invest that money. And if you're doing that, if you're putting money away early on and you're making those sacrifices early on, then you are building good habits early on in your financial life. Therefore, your spending habits will become better, right? And they can really help you as you try to meet other goals in your financial life. It is impossible with poor spending habits, right, and a life full of impulse buying to build a strong financial foundation and to build financial success over the long term. Through early investment, the lessons learned will pay off in the long run, especially when you have more capital to work with and the restraint is needed, right? Because with somebody who has bad habits, right, who has bad financial habits or bad spending habits, as they make more money, then those bad spending habits are going to compound. Those bad spending habits are going to look worse and worse because they are going to have more dollar signs and more zeros at the end of those dollar signs, right? And so if you're somebody who actually builds a strong financial foundation early, as you begin to make more money and have more money to allocate later on in your life, then you will be just as successful with that money as you were early on. But again, it will have more dollar signs and more zeros after those dollar signs, okay? Then, fourth reason that you would want to start early with your investments is because you can be a step ahead of everyone else. Okay, the early bird gets the worm, right? And that is very, very true when it comes to us investing. The earlier you begin investing, the better your personal financial situation will be down the line. Compared to your counterparts who may have chosen to invest later in life, over time, you will be able to afford things that other people can't, right? Because you will be able to build a nest egg for yourself that you can have money to use for whatever you may want to use it for, and or, right, you can invest in smaller amounts and get to your goal, right? Therefore, have more residual income as your income increases over time, and you can take more of that residual income and go on trips and enjoy things with your family and buy the car that you always wanted to buy and do more frivolous type things, right? Because you have the money to do so because you started early and you're still on track with your investing. Right? Additionally, at some point, your finances may become unstable, but by investing early, you'll be prepared to face such hardships because you will have, again, more residual income to help you to do things that you need to do later on if hardships arise, if things arise that are negative in your financial life, then you will be able to hit those head on and not sacrifice the nest egg that you've been building by addressing these particular issues that may come up in your financial life, where other people in your same situation dealing with the same hardship may have to sacrifice what they've built up in order to do something external to saving for their future, to investing for retirement. So the fifth thing, the last thing when it comes to why you should begin investing early, is that your quality of life will improve. Okay. And that's quite obvious, right? Because if you are investing for your future, then you are, one, building good habits for yourself. Okay. And if you can live below your means and sacrifice and build good habits, right, then you'll have more residual income to do with what you want as you move forward. So your quality of life will improve while you are saving for retirement, while you are saving for your future, right? But once you get to retirement, once you get to that ultimate goal of saving and investing and putting money away over the long term, once you reach that goal, the amount of money that you have sitting there is going to be more than your counterparts who were willing to save or invest the exact same amount over time that you did, but they just started later. They will be behind the eight ball. They will be struggling a lot more than you will to build the same amount of wealth, okay? So your quality of life will improve. It will look better, not only in retirement when you get to use that money that you built up, but during your working life when you have more residual income because you're working a plan and you know how much money you should be putting away over time in order to reach your retirement number and your long-term financial goals. So I hope I've been convincing enough today that you need to start early. Okay. Now, this doesn't mean that we do things out of order. This doesn't mean that we put investing ahead of wanting to be out of debt. This doesn't mean that we put investing above having some emergency fund set aside for ourselves. This doesn't mean that we start investing weird amounts because we don't know where our income's going and we're investing when we don't have income to allocate towards investing, right? We have to be budgeting. We have to have a plan. We have to be very calculated in the decisions that we do make when it comes to our investing. And you will be glad that you were calculated. You will be glad that you took a couple extra minutes and said, okay, what's the plan? How do we work the plan? And then walked right down the plan. The financial action plan that I've set out for you is the most efficient way to build wealth over the long term. Now, do I tell you to just right out of the gate, start investing? No, right? But the reason that I don't tell you to do that is because I don't want you to lock up money that you have into tax advantaged accounts that have penalties if you were to take the money out, right? When you don't have any emergency savings or all your cash flow is going to debt, or you don't know where your income's going because you're not budgeting. I don't want that to be the case. Therefore, we have to get some foundational things out of the way before we can start investing in large amounts. You follow the plan. It doesn't matter if you give up just a couple years in the front end. The amount that we're going to invest over the long term will allow you to build the nicest nest egg that you can build for yourself and your family, and allow you to do all the things that you want to do in your financial life. But the key here is that you need to start now. You need to start cleaning up your financial life today. You need to start doing all of the things and building the financial foundation today. That way you can get to the investing portion quicker and you can stay in it longer and allow yourself to build a nest egg that is going to sustain you in your older years and that may help you to do some things during your working life that aren't possible for most people. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that is specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about dividends and why taking them early, taking them off of your accounts as income is a mistake. So thanks for tuning in to today's episode of Money's No Object. I'm your host, Dylan Howell. God bless.